Hi traders, hi everyone. Well, welcome to Market Outlook Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. While I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the normal format. So we'll just check out how and where markets are trading currently. Obviously, it's a huge day for everyone in markets, especially, but of course in the Middle East, especially even more so. We'll just run through first of all, just thoughts on that situation. We'll look at FX, we'll look at oil. We'll look at some sort of observations, just trying to step back, obviously, from all the headlines and all the noise and obviously all the human impact as well. Um, After we do that, we'll then look at, market wise, we'll look at last week's earnings from Nvidia and we'll look at the chart there. Then we'll just, as I say, follow this normal format. Not much else happened actually last week, but there was some inflation data out of Australia and Tokyo, so we'll look at that as well and the charts, dollar yen in that. And then we'll get to this week's economic data, at least. Quite a lot of that top tier stuff. It's obviously the first Friday of the month, so we'll look at non-farm payrolls. There's also some ISM data today and Wednesday, although obviously today we're all really focused on the Middle East. We do get Eurozone inflation data as well as Australian GDP this week. Again, a lot of focus elsewhere potentially, but we will go through this if to obviously see how things develop in the Middle East. We'll look at all the corresponding currency majors as well when we look at some of those data points. I should say, as always, please do ask any questions. If you do have any along the way, then more than happy to answer them. What we're talking about, or of course, what you're looking at as well. Any question, however big, however small, please do ask questions. And also, if you have any suggestions for this webinar, actually, always happy to incorporate and improve hopefully this webinar so it's more useful to you guys for the week ahead. Right, as I say, Middle East obviously front and center for markets and for a lot of people on the globe at the moment. It's interesting. I think market moves generally they're fairly limited given the scale, obviously, of the geopolitical escalation that we've seen. They're not really outsized moves if you look at it and compared to, say, major macro surprises. They're not that big a deal. That's in markets. So stock markets, of course, we're seeing the energy sector. Firstly, if we look at stocks, the energy sector outperforming this morning as expected. But importantly, we're kind of seeing a more we're not seeing the sort of pronounced defensive rotation that we would get, and even just mass selling and de-risking. On a larger macro shock, if you think about it, we typically expect a much clearer shift into defensives than what we have seen this morning. European markets, obviously, they're down, but down sort of 1 to 1.5% or so. That's European markets. Sorry, US futures there not even down over 1%, so less than 1% at the moment. And again, if you think about it in the context of sort of normal daily volatility, that doesn't stand out dramatically. So in itself, really, that market reaction, the equity market reaction, or relative sort of lack thereof, does tell quite an interesting story, really, about how markets are currently assessing the situation in Iran. And we sort of saw this before the weekend and before everything really sort of erupted, if you like. Markets were fairly sanguine about it all. Not sanguine, but obviously relatively calm. Obviously, oil markets broke higher, and we'll look at those shortly on Friday. Sort of textbook technical price breakout, really, on the chart, which will show you. But otherwise, relatively quiet. Were they complacent? We shall see, of course, because the situation is unfolding all the time. But at the moment, relatively contained in stock markets. Rates and other assets, government bond yields from Japan to the US, they've only moved a few basis points really this morning. Um, so that's kind of interesting. The FX fallout, before we get to this crude oil chart, um, the FX fallout again is relatively contained, really. We've seen modest flight to safety flows, so the Swiss franc gaining. But we've not really seen sort of big 1% plus moves in some of the key majors, really, that would signal panic. Certainly, the Aussie dollar, that did move more than 1% actually in early Asian time, so with thin liquidity, but that's since recovered very much so. And really, then again, that tells us markets are fairly cautious. They're not really in full risk off mode yet. I should say the backdrop sort of more supportive than for the dollar at the moment, and that's probably for two key reasons. We think you have to remember the US is far more energy independent now, and certainly much more independent than Europe and much of Asia. So that means when oil and gas prices jump, energy importing economies, just for your guide, obviously, see their trade balances worsen, which can then pressure currencies like the euro, like the yen. We saw that actually in 2022 when sustained high oil prices helped drive a stronger dollar trend. So potentially that's what we're seeing, or we are seeing that at the moment. We've written about it actually in the week ahead, and also in some of the daily commentary we put out, just that the sort of haven bid when oil prices are impacted. The haven bid does go to the dollar. But when oil prices aren't impacted and the market is uncertain, then the dollar doesn't gain as much. And we've definitely seen that since sort of Liberation Day, and obviously all questions around uncertainty, policy uncertainty in America. So yeah, the dollar really being supported, interesting phenomena at the moment. Obviously, if energy stays elevated, that dynamic can continue. Otherwise, interest rate expectations are shifting a little bit as well. So if you think rising energy costs can keep inflation sticky, elevated basically, and that then makes it harder for the Fed, the US Federal Reserve, to cut rates. Markets kind of dialing back expectations for easing a little bit already, actually, following recent signals from some of the FOMC officials. Certainly, fewer rate cuts then generally would support the dollar as well. So that's sort of observations on there. Otherwise, yeah, we've seen sort of euro and the yen as net importers of oil really sort of underperform. Swiss franc outperforming on haven buying. We've had noises actually from the S&P, I think, this morning about possible intervention if the Swiss is too strong. But let's leave that alone for the minute. As I said, the Aussie dollar did sell off very strongly in Asia, but has sort of made that back. Is only down now around 0.38%. Kiwi dollar, probably the worst performing now, down over 0.5%, just over. Otherwise, sorry, yeah, I think sterling's around that as well. Euro is probably the worst actually at the moment, worst performing, down around 0.6%, I think, last time I looked. But there is issues around natural gas. Gold obviously higher, and silver too, but not majorly. I think again, sort of less than 2%. And Bitcoin, well, that traded over the weekend actually and sold off initially, obviously on the first news, but then sort of made it back and has sort of been less volatile than usual for what it's worth. But really, most asset classes have moved really not move, sorry, more than they might have on, for example, say one of the big non-farm payroll releases, for example. So, yeah, we're just thinking about that at the moment. Obviously, things can change. And as I said, natural gas is potentially being exploding to the upside, actually, with Qatar saying they might stop production because of military threats to their plants. That impacts then Europe for sure as a big importer of natural gas, and also the fact that I think their storage levels are lower than they should be at the moment. Otherwise, moving on to oil, that is clearly the focal point at the moment. Initial spike of 13% we saw overnight, but now crude trading around 6 to 7% higher last time I looked. This obviously the key variable to monitor, and really it's around the security of supply through the Strait of Hormuz. That's where approximately 20% of all seaborne oil and gas passes through. That's global seaborne oil and gas. Then another aspect just as well to monitor is obviously the response from other major powers. So far, that relative silence really from the larger global players, China, Russia of sorts, that's pretty noticeable in itself. Ultimately, oil is, of course, the transmission channel into the global macro environment. But at this stage, markets again treating this primarily as a sort of oil story. And until that changes, broader market reactions likely to remain kind of contained. Um, so far, I'll say that a few times probably, Iran has not explicitly stated that it intends to close the Strait of Hormuz. There's been speculation, but I don't think it's been official at all. Historically, even during prior conflicts actually in the region, including the so-called tanker war, we didn't get a full and sustained shutdown of the strait. Just remember that. Oil continued to flow. It's also important probably to remember that there is a credible path to securing tanker traffic, actually, with military assistance to ensure continued transit through the strait. Through the strait. I know there has been some insurance issues and potentially not insuring tankers going through that area. And that may be an issue, but again, you would probably think the US has looked at that kind of thing. Key question really is not really then whether tensions are high, they clearly are, but whether we see this sort of material and lasting disruption to physical oil flows. That really is the sort of real macro, if you like, transmission channel. Otherwise, sort of more broadly, I guess, just before we get to this oil chart and oil as well, Brent crude, yeah, we're sort of focusing. Really, you have to focus, yeah, only on economic, financial market implications. Obviously, that may sound a little bit tough, a little bit cold, but that is how markets function. As always, with geopolitical escalations, the key question is what are the potential macro impacts, the effects. So, in a global context, if you think about it, Iran, several neighboring countries, not major macro powers, their direct weight in global financial markets fairly small, and that is the key reason really why market reactions at the moment have been relatively contained, as we've explained. As we've seen in other conflicts, for example, in Ukraine, or when that conflict between Hamas and Israel broke out, the markets quickly narrowed their focus to the sort of macro transmission channels. As long as oil and gas continue to flow through the strait, global markets can, in principle, function even amid really this significant regional instability. There are other factors as well, sort of in favor at the moment, if you like, compared to, say, 2008, when that all kicked off and we had an unfavorable macro environment there. At the moment, and as we mentioned, US oil production structurally very different this time, much higher level than previously. Financial conditions very supportive, and we're in a relatively disinflationary environment. So even with oil, say, up 5 to 10%, the negative macro and inflationary impact likely to be relatively limited. We'd need to see significantly larger, basically, this is the key point, more persistent price increases for this to become a genuine macro problem. If you remember in October 2023, with Hamas attacking Israel, we had a big oil spike that proved temporary. And really, then the message is obviously be careful about extrapolating a large negative oil shock from current conditions. If the macro effects are small, there is potentially no need for meaningful monetary policy adjustments. And generally, geopolitical issues across the board, really, through history, they rarely become major investment issues over the long term. and certainly if the economy is on a solid footing. Obviously, short term, we're getting lots of noise, but that is trading opportunities as well. So, yeah, this is just the chart first up, just to show you of what's happened recently with oil prices, and of course, some of the geopolitical impacts to the price. If we just pull up the Brent crude chart now as well, just bear with me, which is here. Let me just show you here. So this is the Brent crude chart. Let me just pull this back. Get rid of this. So you can see big spike higher. Obviously, I was referring to this nice breakout. If I just pull up there, you can see classic breakout really, and even here as well, we've been sort of steadily going higher since those lows below $60, which we've highlighted. We also broke that small downward trend line there. Obviously, track sideways between 68 and 70, then nice push higher. Track sideways between 70 and 72, push higher. And then that broke that high from July at 72.79. If I just pull this back again, really interesting that then we've tapped this high from last year, the start of last year, 81.80. I think we got above it. 81.96, the high on my chart. It might have gone a touch higher. But yeah, around $82. Tapped that high from the high from last year, as I say, January. And then we've pulled back down, and we've also pulled back down then below that high from June last year as well at 79.46. So we're just below there. I think it's interesting. I think if you look at Twitter and X a lot, I know that there's quite a few economists or even commentators who talk about charts and saying you should put all your, lines away on charts because they're meaningless in events and in situations like this. For me, and what I've experienced and seen and heard, even with people who don't look at charts, I remember distinctly quite a while ago that some equity fund managers started getting out charts and referring to price levels when things kicked off a few years ago, pre '08 actually. Um, and I found that really interesting, and I've especially believe that is true because prices generally gravitate to major price levels. You might not get the price levels right, but they will be meaningful at some point. And I think this is a really interesting point. Last year's high, 81.80, we got up to around that level and then pulled back sharply through the Asian session and the European session. We're just now below, as I say, that quite important spike from June, but obviously things are very fluid, I should say. Okay, that's oil and the situation in the Middle East. Hopefully, that's of use to you guys and our thoughts. As I say, very fluid situation, so things can get much worse, no doubt, if and we're not geopolitical experts, although obviously follow it in great detail. But yes, if there's sort of wider participation in the military, exercises and retaliation, even. So, UK, Europe get involved. If some of the Middle Eastern neighbors, they also get involved, which is potentially what Iran are wanting by obviously hitting US bases in those countries, in their neighbors, to really stoke the US up, but also then to potentially make it pull back. I don't know the tactics by Iran, of course, but possibly that's been floated by various commentators. Then, yes, things could get a lot worse. I should say the stated aim of President Trump was regime change, and he, I think, is definitely quoted in saying this will last a few weeks. So that sort of put pay to any notion that this was a sort of surgical few strikes and a series of those. This, he said, is going to go over a few weeks, and to expect US casualties. I think that was very important as well and noticeable on the weekend. So potentially, if this goes on for a long time, then yeah, we'll still be watching the Strait of Hormuz, of course, the price of oil, and whether it's just a regional issue, of course, or whether other parties have got involved and there's wider macro issues, if you like. Hopefully that's explained, yeah, where we are at the moment with this. As I say, watch the headlines, but also there's a lot of headline havoc because things can whipsaw and be very choppy in price action as well. Okay, moving on from this to Nvidia actually. So bear with me one second. Just pull up the chart of Nvidia. Obviously, things are going to change as we open. But yes, big earnings obviously last Wednesday, most anticipated earnings report of the season. Let's not kid ourselves, really. Big headlines, really, but then or amazing headlines actually with some of the stellar numbers, but then really questions around how long this can last, really, and then just a few other questions around hyperscalers and also chip supply and demand, actually. It was interesting. Nvidia actually sort of opened, well, pre-market was up and was set to open around 1% higher just a few hours before, but then markets really sold off after the results on Thursday. You can see that there. We got markets down. I think Nvidia closed down around 5% on the day, actually, and then we got another 4% on Friday. So big move in the biggest stock, or the most biggest market cap stock in the world, of course. Just for your guide, then Wall Street numbers, because important to tell you these. Q4 revenue 68.1 billion came in at above the 65.7. Data center revenues, they are the main revenue driver. Of course, they came in 62.3 billion versus 60.5 estimates. Total revenue that topped $200 billion for the first time, so grabs lots of headlines. And then Q1 2026 revenue, that was 78 billion. That beat estimates of 71.7 billion. And then Q1 2027 guidance, that's meant to hit 78 billion as well. EPS then, Q4, that was $1.63 versus estimates of $1.52. And gross margins, they met estimates 75% and are expected to sustain through until April. So key for us really sort of three things really: AI chip demand, the Chinese market, and memory chip shortages. On the first one, chip demand. Well, Jensen Huang, the CEO, of course, he said he was confident in hyperscaler cash flow growing, but the tech giants certainly now face the prospects potentially of having to borrow this money as they burn through their cash. Of course, if you're not a hyperscaler and trying to do this as well, then you are funding this through debt and borrowing the money, which is being frowned upon really by markets. I think CoreWeave, classic example of that, and getting hit quite strongly. On the Chinese market, I think this is interesting though. Nvidia didn't include any chip revenue, AI chip revenue from China in its projections. So access to that crucial market could lift revenue, of course. And then memory chip shortages. This is probably also very, very important. Data center builders are basically hoovering up the limited supply of high bandwidth memory from just a handful of companies. We're getting a supply crunch essentially, and that could worsen. And then that could mean Nvidia's margins are harder to predict. So yes, really not just about Nvidia. Really, these results really a check on whether the AI engine really is still powering the bull market, of course, and still running at full throttle. And really, if there's more to come, it was the 14th straight beat on numbers. Huang and the CFO, they did guide strongly, so that means momentum is still there. But well, and the growth story remains intact, but sky high expectations really, really tough to beat. And there were worries, as I say, about memory chip shortages. and of course some of the hyperscalers cash capex numbers that they are putting out. Just for your guide, and I talked about this in the podcast actually on Friday, that Amazon, if you remember, their capex to this year is $200 billion. That means they're spending 550 million per day this year, just as a guide. Okay, that is Nvidia. Chart wise, you can just see we're now below the 50-day moving average of 185.62. We've got support where probably around here, 170 or so, initial support. Then you've got a major fib level of this move from the Liberation Day lows up to the high. 38.2 is at 164.22. So that taps that low from September of last year. Upside capped, of course, by last week's high at 197.63. Okay, moving on. In fact, should we just look at stocks quickly? Just bear with me 1 second. Do we want to look at stocks? I think we do. Bear with me. Yeah, I'll just pull up a couple of indices here, obviously with everything going on, and just some levels we're looking at. So the S&P, yeah, now down over 1%. Nasdaq now down over 1.4%. You can see here. Let me pull up the futures chart, which is here. As you can see, that move, we're still sort of within the range. Um, First minor fib level is a 66.98 on the cash, but we do have support, initial support around these lows, which is around 67.88. You can see there. This is the cash, as I say. 50-day moving average is 68.99. 200-day will be well below that. Let's just have a look, shall we? Oh, well, first the 100-day. Actually, we're just on the 100-day, so we might be moving below that 68.31. And then the 200-day, as I say, below at 65.59. NASDAQ, you got the 200-day, which that will be, or will it? Bear with me. Yeah, 24,106. Probably initial support around this low at 24,387. And then you've got a major fib level actually, but this is down, not the fib, not the Liberation Day lows, but from this low in May. So you've got 24,054, which tallies with this low from November of last year. That's a 38.2 of this retracement, which tallies actually just, yeah, with that, 200-day moving average. So that's probably a decent zone of support there. Um, just on the Dow, holding up, although again, futures showing that down over 1% now. Just potentially breaking out of this bull channel. We have broken out of it before, sorry, but I have kept it in there. So interesting, we're just around that. Um, First level, well, first levels would be probably around this previous high and then these lows as well, which I would say was at around 48,400 or so. Then you've got a minor fib level. This is the from those Liberation Day lows. So long term here at 47,221. Okay, moving on swiftly. Um, just some CPI data from last week, actually, very briefly. We had Australian inflation that slowed from 1% month on month to 0.4% for your guide. That helped stabilize the annual number at 3.8. Consensus was looking for 3.7. Biggest contributor was housing. Electricity prices, they remained influenced by the government rebate programs. Food inflation remains high. And then the trim mean, really, we should focus on. That's the key for the RBA. That accelerated month on month to 0.3%, and 3.4% year on year. Really, all just bolsters bets that, well, did bolster bets that the RBA would follow up after its inaugural 25 basis point rate hike, probably by May. Very highly priced there, above 90% actually after that data. May have just been reined in slightly, obviously, with what's going on now. But a back-to-back hike in March was pretty slim, but May pretty much fully priced in. That's in Australia. And then, as I said, on Friday, we got Tokyo inflation out of Japan. That slowed in February with the CPI excluding fresh food at 1.8, down from 2% in January. Marks actually the first time in 16 months that inflation has fallen below the Bank of Japan's 2% target. The decline driven by the impact of fuel subsidies and the removal of gas tax surcharges, while the effects of recent food price hikes have largely subsided. Let's just look at dollar yen. Obviously, he's got the haven nature of the yen, although, as I mentioned before, the yen is, Japan is a net importer of oil, so potentially its terms of trade are impacted by obviously much higher prices, and that may be an issue for the yen. And you can see actually dollar yen is going higher, so the safe haven qualities, as we mentioned, of the dollar, beating so far the yen. Interesting. So we're at 157.18. This is dollar yen. Those highs at 159.46. Key level really around that 160 level for intervention issues as well. If you remember, we talked about that and the rate check, which was confirmed actually, and actually may have been brought on by the US and Scott Bessent. So just watch out if we do go much higher, sort of towards 160, then verbal intervention and more potentially if we do go higher on this. And that it will be really interesting for the White House and the administration with the stronger dollar, although obviously oil prices going higher as well. Okay, moving on from last week to this week's main events. Which are, of course, US data. Bear with me one second. Sorry. Yeah, US data and non-farm payrolls on Friday. Here is the graphic, and then we've got a chart as well, just with the headline. Obviously, we do get lots of other labour market releases as well. Early high frequency indicators like the initial jobless claims, ADP's weekly private sector employment estimate, and also Indeed hiring labs daily online jobs posting. They generally signalled improving labour market conditions into February. The weekly initial jobless claims, as I say, steady over the comparable survey period for the non-farm payrolls number, while continuing claims rose modestly. Obviously, Friday's the big number, non-farm payrolls, which will shed light on whether actually the prior month's unexpectedly strong data was a one-off surprise or obviously signs of a more robust labour market. Expectations then, 60,000 is consensus at the moment. That will change through the week. And that comes after that big gain of 130k in January. And that would just be the 60k just above the estimated 50k break-even pace. Just remember that. Unemployment forecast to stay steady at 4.3%. And then wages tick a tenth lower, probably back to 0.3% or so, 3.7% year on year, I think that is. Data, pretty much one of the last major releases before the Fed's March meeting, and comes, of course, over a lot of attention, sharpening on how AI could affect the labour market and the broader economy. For your guide, well, at the moment, it's a coin toss between a rate cut in June or not by the Fed. Interesting, I think, though, many officials on the Fed actually view the labor market now as pretty stable, pretty resilient, having cooled gradually, but now showing signs of stabilization. Unemployment is low. Remember, layoffs subdued, vacancies pretty steady. So possibly then it means officials' focus may shift away from employment then towards inflation. And certainly with oil prices rising, and if they're sustained and persistent, then that will be a focus. Several officials, actually, just for your guide as well, have stressed the need for, anyway, clearer evidence that price pressures, particularly in core services, are returning to target before considering any further rate cuts. I think just touching on energy, as I say, persistent and elevated prices are key to impact inflation over the long term. Remember, policymakers will often look through just one-off spikes and focus on the medium to long term, or certainly the medium term onwards. So just bear that in mind, of course, with match speculation if or when or sorry, if really, when and if oil prices stay high, how long for. Um, Obviously, Fed speakers will be interesting as well, and you'll get a lot of that on the wires, really, about them talking about the potential impact of higher oil prices. But as I say, if that is just a spike and not over the medium term, then they would often typically look through that and really not change policy for that. Just got a chart with a headline number, 60,000 expected, just relative to the other previous headline numbers as well. You can see that 130K previously. In the coming week as well, we do get manufacturing and services activity. As I said, probably may not be that important today. Of course, manufacturing, though, we get later in a couple of hours. Just for your guide, February activity expected to tick down a little bit, 51.5, 52.6. January actually expanded for the first time in 12 months, so above 50, and that was really down to post-holiday reordering. And the employment index stayed in contractory territory, though. The recent ramp up, of course, in trade pressures that may drag on this number, while prices paid probably remain elevated, especially due to rising oil prices. We do then get the ISM services data on Wednesday, non-manufacturing, probably pretty similar, 53.5 and 53.8. Regional Fed surveys, they do point to modest picture, softer picture actually, while trade tensions have also increased, of course. Um, Services sector, I would say this accounts for more than two-thirds of US economic activity. Also on Friday with non-farms, we do get US retail sales. Consensus expects that headline to fall actually, negative 0.3% versus the prior flat print. Basically, consumers they usually pull back after the holiday season, and also we've had colder weather, which will probably weigh on activity. If we look at the dollar, then let's just pull that up. Obviously, influenced as we talked about by safe haven bid and oil. So here's the DXY here. So let's just pull this up so you can see that move higher today, breakout of that consolidation pattern, really. So potentially moving up through the 200-day moving average, actually. The blue line, it's normally the 50-day. Sorry, that's why it's throwing me. Double check. Yeah, it's the 50-day, 200, but that's at 98.35. So interesting if we can get through there or not. You can just see we've broken the 50-day moving average. That's at 97.90. And then if we pull this back, this is a very long-term fib level, I think. So let me just, sorry about this, pull up the weekly. Uh, and you've got a long-term fib level that comes from, yeah, way back. This is a very long-term fib level, but interesting, I think, because, yeah, it comes from that 2011 trend line that I'd like to point out to you guys, which touched then those 2021 lows, and you can just see a major fib levels at 98.70, the 38.2 of this move higher up to that high at 114.77, and the 38.2 retraces at 98.70. So this is the weekly chart. So that is kind of interesting as we get up to that. Otherwise, you've got these highs here, 99.50 or so, and then these highs from the end of last year around 127, 130 or so. So that's the DXY. Otherwise, just quickly, we've got time for euro dollar and inflation data we get out on Tuesday actually won't be a big mover. It has to be said. Just for your guide, consensus expects the headline to tick up 1/10 to 1.8%. That's just below the ECB forecast of 1.9%. Core should steady around 2.2%. Services inflation just above 3%. The regional numbers, they showed French and Spanish readings slightly above expectations, while Germany was below expectations. Bottom line, though, to be honest, um, the ECB is in no rush, obviously, to cut rates. They're in this good place, as President Lagarde has consistently said, as well as that being echoed by other officials. As such, really no change to near-term policy, and the euro will be guided by Middle Eastern events, gas and oil events as well. You can see it's taken a turn actually. So below the 50-day moving average at 117.76. Probably big support there from that January low at 115.76. And then you've got the low from November at 114.68. Obviously, that's some way off here, but interesting move lower. I just want to see actually the intraday move. Yeah, you can just see that. I think on this news that Qatar is stopping the LNG, their LNG production. Yeah, watch this space very closely for that. Okay, we will wrap it up there. Just bear with me, and I'll just show what I normally do. Which is just our social media handles here. So please do follow us on those. And as I always say, daily commentary out after the US close. We'll just try and touch upon what's obviously going on with the Middle East at the moment and just trying to catch up on all the headlines. And especially this breaking news that is happening quite a lot. As I say, just be careful because obviously so many headlines, you can get whipsawed quite easily. And it's just worth sort of checking, obviously, risk management that we all do or we do with stops and position size, and just generally just sort of keeping an open mind on the bigger picture as well, we would say. Okay, thank you so much again for tuning in. Really do appreciate. There's a hardcore of you actually that do tune in every week, so that's really fantastic. Take care out there, and we will speak to you same time next week.